There's a little bit of volatility in the US economy right now, particularly if we're looking at banking and mortgage rates. The first thing that's going on is we do have a couple of banks out in California who are now receiving quite a bit of support from the federal government. And the second impact on the housing market is that the Federal Reserve did come out yesterday and they are choosing to prioritize controlling inflation over focusing on a potential banking issue. And they continued to increase interest rates. Now, we know that the Federal Reserve does not set mortgage rates. However, their actions can impact mortgage rates. So let's have a quick chat about how these two factors are impacting mortgage rates today. In the financial markets is important when it comes to housing and how it's actually impacting housing. So the first slide that I've got up on the screen here for you is a quote from Sam Cater. And Sam Cater is the chief economist of Freddie Mac. And Freddie Mac records interest rates, and they create a lot of the charts that we use on these. And he says that mortgage rates are down following an increase of more than 0.5% over 5 consecutive weeks. And what he's saying there is that for 5 weeks in a row, and I think they recorded on Wednesdays, interest rates went up by 0.5% for 5 weeks. He goes on to say that turbulence in the financial markets is putting significant downward pressure on mortgage rates, which should benefit borrowers in the short term. And what we can see here is this is a chart of the mortgage news. It's put out by Mortgage News Daily, and it shows the daily fixed rate. And we started the year in January 3rd, the first business day of 2023, and the mortgage rates were at 6.45%. Then we saw this stretch of time here where it kept going up and up and up and up. And now if you look at the orange bar all the way over on the right, as of March 17th, which was last week from me filming this, it was down to 6.55%. So if we kind of blow this up and just look at this month, on March 2nd, which was the first business day in March, it was 7.1%. Hold on, somebody's calling me. It was 7.1%. It's down as of last week to 6.55%. Why does that matter? Well, if we listen to Nadia Evangelou, who's the director of real estate research at NAR, she says, following the trend of the 10-year Treasury yield, the average rate on a 30-year fixed mortgage dropped to 6.6. However, they may decrease even further in the coming weeks, depending on reactions of the financial market to the outcome of the Fed's meeting next week. Now, she wrote this last week. That meeting took place yesterday, and the Fed chose to continue to focus on inflation. And what Jerome Powell said was that he felt the banking market was stable and that it was more important to focus on the very good jobs report that came out and to continue to try to slow down inflation. Why does this matter to us? Well, because the higher the mortgage rate is, the more expensive it is to borrow money to purchase a home. So it's really not impacting the cash crowd as much. We'll talk about that at another time. But if you have to borrow money to purchase a home, the higher the mortgage rate is, the more expensive it is for you to buy a home. If you look at this chart from Mortgage Daily News daily rate, it's showing you let me move my little face over there. You can see that the column on the right is buyer demand, and then it's the bars on the middle and left are where the mortgage rate is. So when the mortgage rate is up like 7.5%, buyer demand is very weak. And when the mortgage rates are low, down around 5.5%, buyer demand is very strong. Why? Come on, slide. There we go. The seemingly significant drop between 7.1% to 6.5% was enough to make home buying affordable for more Americans. And that's, again, Nadia Evangelou, who is the director of real estate research at NAR. If you don't know how this works, let's take a look. Let me go back to my slide of what this actually looks like when you do this. Say you're borrowing $500,000. If you purchase it at 7% interest, that means your principal and interest, assuming everything else is equal, is going to be about $3,326 a month. If you can purchase that same amount of money at 6.5%, your payment drops to $3,160 a month. That's $166.17 in savings. And that makes a difference. That pays a utility, or that pays something else that might force that buyer out of the market. If you go even further and you drop that rate to 6.0%, you can see that they save $328 a month. The payment drops to $2,997. So that's why there's all this conversation. We have to see how the market is going to react. We know that the Federal Reserve has come out and said they feel the banking is very safe. We have to see how investors are going to react to both the California bank problems right now, the Federal Rate Reserve, but it looks like there's some downward trending in mortgage rates. So right now we're right about 6.6%. That should make it a little more affordable. Watch this space. We'll try to keep you informed. I'm Sandi Warner with Warner Realty Group. If you haven't yet subscribed to our channel, hit that subscribe button and give us a like if you found this information good. Talk to you soon.